This lecture is an introduction to financial statements. So I'm assuming at this point you've had Accounting 1 and Accounting 2. So we're really just trying to review financial statements, specifically the income statement and balance sheet, and give you an idea of how it's going to impact what we do here in financial management. I've tried to give you a decent level of notes here, but this is really just an introduction. So we're just trying to get ourselves acquainted with how accounting and finance work together. So let's get started. So for this unit, we want to look through the main financial statements, specifically income statement and balance sheet. We want to look at how a balance sheet works, how it generates cash flow, and we want to look at an income statement and see how debt and equity fall in line on it. And then finally, we want to define two terms that finance uses from financial statements. The first is market capitalization, and the second is enterprise value. When you think about a balance sheet, it's a snapshot. So it shows what the firm is doing at the current moment. So it shows the accounting or historical value of the assets the firm has in place. So there's really two sides to a balance sheet. The asset side is what they do with the money. So in other words, do they put it in inventory? Do they buy plant, property, and equipment? Do they run accounts receivable with it? It's what they do with it. The liability and equity side is where did they get the money that they employ? So they raise it from debt holders. So a debt holder typically might be a bank or a bond holder. Or did they raise it from equity? No two firms are exactly alike in how they approach their business. If you look at the asset side of the balance sheet, the way accounting rules are set up, you try to set up your assets from the most liquid to the least liquid. So in other words, cash would be your first item on a balance sheet because it is cash, and that's what liquidity means. Notice how we lump cash, accounts receivable, and inventory all together, and we call them current assets. They're current assets because typically they will create a cash inflow for the firm in the coming months. So from a finance perspective, that means we'll receive a cash flow that we can invest. So they're going to generate value for us eventually. Now at the current moment, they're money that is due to us, so they haven't created value yet. That's the key thing to remember. This is potential that we're looking at. When we look at total assets, that's just the sum of current assets and the long-term assets. Now I'm going to go back real quick to the previous sheet, so hopefully I'm not going to make you dizzy jumping back and forth. But if you look at long-term assets on this sheet, you see it's at a value of 113.1. I guess it could be million, I forget what the units are. But the point is, plant, property, and equipment are long-term investments that we don't intend on selling anytime soon. So the 113.1 represents their historical value. So that's what I paid for these things minus any depreciation that I've taken out on them. Key point, that does not mean that I could sell them for that amount right now. You know, an example here in everybody's personal life, your parents or some other relative probably owned a house here in the last 5-6 years. Now, what they paid for it a long time ago versus what they could sell it for today, based on sort of how our economies struggle, are two different things. What you pay for something is now become the book value. What somebody's willing to pay for it now is a market value. In finance, our focus is always going to be on market values. If you look at the liability side, it's the same principle. Our short-term liabilities are all lined up under current liabilities. So we have accounts payable and notes payable. That is money that I'm going to have to pay out here in the coming months. Accounts payable is what I pay to vendors. Notes payable is what you pay back to a bank. That's like a credit line, something such as that. When we move down the balance sheet here on this side, long-term liabilities are typically bonds or mortgages, things that have a due date not in the immediate future, but somewhere down the line. And then once we add up the liabilities, that's current plus short, we get to the equity side of a balance sheet. So that represents the owner's stake in the firm. Now recognize, once again, that's their book value. That's not what somebody would value the stock necessarily on the market today. What we hope for as a stockholder is that our market value of our shares, so what somebody would pay us for our shares, is a lot higher than the book value or what they were originally purchased for. We call it shareholder equity. So here's sort of some notes that summarize what I just told you. Now the income statement summarizes a time period. Now, typically firms are going to put out a quarterly income statement as well as a yearly income statement, summarizing what the firm has done over that specific time interval. Now what we'd like to see is where debt and equity show up on an income statement. Debt is going to show up as an interest payment. So remember, when we take out debt from a bank or a bond, we pay interest to these individuals, and that's an interest expense. Now the nice thing about interest is it's a line item expense on our income statement, so it reduces the amount of taxes that we have to pay, which can help the firm, of course. Net income is where our shareholders show up. Now this is money we've earned for the shareholders. It does not mean we have to pay that money out to them. Keep in mind, net income can be reinvested, and it's called a retained earning when it gets reinvested. Let's look at an income statement. Now from a finance perspective, as we go down this income statement, we see sales and we see cost of sales. You can really call that cost of goods if you want, which gives us gross profit. If you keep working down the income statement, we pull off selling and administrative, research and development, depreciation and amortization. We get operating income, and eventually we get down to earnings before interest and taxes, or EBIT. This is going to be a critical number when we start doing valuations in finance, because think about what it represents. This is what the firm has done before we've paid any investors, before we've paid any interest, before we've paid any dividends. This is how well we've done. The nice thing about this number is it's somewhat pure. It doesn't matter how I've raised my money for running this business. So when I look at an EBIT, or sometimes folks don't pull depreciation out, but that's another day. When I look at EBIT, I can compare it to another firm, and we can sort of say, how are the operations of the two firms doing? What is the cash we're generating? Well, as I've said, there's a difference between book value and market value. One way we measure market value of a firm is we start with a stock. And the way we value the stock on the open market is called market capitalization, or sometimes people just call it market cap. It's really, what is the value of all our trading shares on the open market? Not the book value or accounting value. We don't want shareholder equity here. We want, what is the value someone will pay for our shares? The way we calculate this is we take the number of shares we have outstanding times the current trading price per share. So for example, using the financials that we had previously in this set of notes. Now I'll also have a PowerPoint of this available on the main page, so you can download these financials and look at them. Global has 3.6 million shares on the open market priced at $10. Its shareholder equity is $22.2 million. So the market cap of Global is 3.6 million times $10, or $36 million. Now notice the market values Global's shares more than what it shows up on its books. And really what this is saying is the market sees long-term growth potential and that shareholders are going to get a return on their investment. Well, if you think about market cap as the value of the equity holders, enterprise value is sort of like the value of the whole firm. So market cap's like a slice of pizza, enterprise value is the whole pie. Okay? Enterprise value is the value of all the investors in the firm. And the way we calculate it is we just take all their market values and we pull out cash at the end. We'll talk about that in a minute. So we take the market value of common stock plus the market value of debt plus the market value of preferred stock, and we subtract cash. Now the reason we pull out cash is if somebody were to buy this firm today, they'd inherit the cash. So it'd be like if, say, I went to a local restaurant and bought it for $100 today, but they had $10 sitting in their cash register. Well, I would get that. So really my net cost would be 100 minus 10, or $90. So that's how we do enterprise value. We get the value of each type of investor and add them up, since they're all part of the firm's overall size, or pie, if you want to think about it that way. Now in reality, it's kind of hard to get market values of debt sometimes, because debt's not always traded. So what we often end up doing is we just simply use the balance sheet value or the book value. All right, for example. All right, so you might want to hit pause and read through this before we work it. So if we look at global, it gives us their shareholder equity again, the book value. It gives us the notes payable and long-term debt and cash. And we already know that they have 3.6 million shares priced at $10. What's the enterprise value? Well, we get the market value of equity at $36 million. We already did that. So we add up enterprise value. We take the value of the common stock, $36 million, plus the value of the notes payable, $5.5, plus the long-term debt, and we subtract the cash, and we get $131.5 million. Now before we go, there's one common question that always comes up here. Well, why didn't you include accounts payable? Well, when we do this, we only include investors. And a debt investor is somebody we actually pay interest to. An account payable is just something I've bought from a supplier that I pay him off every month. I don't give him interest. So we only include debt holders who are actually investors. Hopefully that clears that up. Well, if you want to think about what this is, it's the price tag of the business. So if I want to say, what is this company worth? Let's add up the parts and see what we get to.